This chart tracks two metrics that usually move in tandem: home prices and sales volume. But look at the divergence. Transaction volume has plunged to levels not seen since 1995, while the median home price remains at a record high. This creates a contradiction. In any normal market, when demand drops and fewer people are buying, prices should adjust downward to meet the market. That is how the basic laws of supply and demand are supposed to work. Instead, those two lines are pulled further apart. The housing market has reached a state of total stasis, where the typical pressure release of lower prices has stopped functioning. The market is frozen. To see what this freeze looks like on the ground, let's look at Maya. She's 31, works in healthcare, and earns $74,000 a year, well above the national median. She has a 760 credit score and has spent 3 years sacrificing to save $31,000 for a down payment. Maya is the historical archetype of the successful American first-time homebuyer. She has done everything the financial manuals suggest. This visual breakdown shows why she's stuck. To buy the median-priced home in her city today, the mortgage, taxes, and insurance would eat 65% of her monthly take-home pay. After housing, she'd have just $1,600 left for utilities, food, student loans, and transportation. Maya is essentially being excluded from the market. She earns a solid income, yet the math to buy the median home has separated from the reality of her paycheck. When prices stay this high while sales fall, it's natural to assume we're in a bubble. But today's metrics look nothing like the 2008 financial crisis. The 2008 crash was driven by soundbite lending, liar loans, and zero-down mortgages offered to people who couldn't repay them. When prices dipped, millions of owners were left with negative equity, triggering a wave of forced sales and mass foreclosures. Modern borrowers are in a far stronger position. Credit scores are at record highs, and homeowners are currently sitting on over $35 trillion in collective equity. 2008 was a fragile market that shattered. Today's market is a rigid one that has simply stopped moving. It will likely continue to absorb a higher share of people's income while grinding sideways. The root of this rigidity goes back 15 years. After the 2008 crash, homebuilders pulled back so aggressively that construction levels stayed below historical norms for an entire decade. What did get built was targeted at the high end of the market. Construction of the starter home, units under 1,400 square feet, plummeted by 80%, effectively removing the traditional entry point for first-time buyers. That decade-long pullback created a massive cumulative deficit. Today, the United States is short an estimated 4 million housing units. This shortage has effectively discontinued the primary wealth-building tool for the middle class. There simply aren't enough rooftops to meet the demand. Then came the pandemic. In 2020, the Federal Reserve slashed rates to near zero, triggering a massive buying spree and a wave of remote work migration that drained what little inventory was left. When inflation spiked, the Fed reversed course with the fastest rate hiking cycle in 40 years, pushing mortgage rates from under 3% to nearly 8% in just 18 months. This chart details the resulting lock-in effect. Over half of all current mortgages are below 4%. For a homeowner to sell and buy a new home today, they'd have to pay a financial penalty of $65,000 just in extra interest. This traps inventory. Millions of people who might otherwise move are staying put to keep their cheap debt. That leaves Maya competing with cash-heavy baby boomers for the tiny handful of homes that actually hit the market. The market is being held hostage by the math on the spreadsheet. The financial penalty for moving has become so high that the rational choice for millions is to stay in a house they've already outgrown. Many buyers are waiting for interest rates to drop back to 5%, assuming that lower rates will finally fix affordability. But the data suggests a different outcome. Look at this projection of the bottleneck effect. If rates drop quickly, the millions of buyers currently on the sidelines will flood back into the market, but they will collide with that 4 million home supply shortage, which could drive prices even higher. The most likely path forward is a slow, multi-year correction. Prices will likely move sideways while incomes gradually rise, and the lock-in effect will only fade as people are forced to move by major life changes like retirement or new jobs. A rapid rate cut might feel like a cure, but without more houses to sell, it would likely just repeat the price surge we saw in 2020. You'll constantly hear from the real estate industry that now is a great time to buy. It's important to remember they have a structural incentive to say that. They only earn a commission when you participate in the market. The only reliable guide is the math. If your total housing costs would exceed 30% of your gross income, the numbers don't work. Stretching to 45 or 50% doesn't make it a good time to buy. It just makes you a future statistic. In this environment, renting an affordable place and investing your savings into an index fund is a completely legitimate strategy. In a high-price, high-rate market, the returns on an investment portfolio can often outperform a house. You are not failing at adulthood. Between the decade of underbuilding and the record-shattering rate whiplash, the math of home ownership has simply separated from the reality of local incomes. Running your own numbers is the only sane way to navigate a market this expensive and this frozen.